Good afternoon to you all. I'm Stefan Schneider, the owner of the German M&A Review magazine. On behalf of M&A Review Europe, which is a joint initiative of the French-speaking M&A magazine Fusion Acquisition and the German-speaking magazine M&A Review, I would like to welcome all of you to the first webinar of the webinar series Insurance and M&A Transactions. In the light of the recent political, economic, as well as technological trends, the M&A Review Europe series offers European M&A market participants guidance of multitude of articles and services on M&A at one place. Insurance and M&A transaction as the first topic of M&A Review Europe was carefully selected. Given the growing uncertainty in the markets, the importance of adequate and tailor-made insurance solutions as M&A deal facilitator has significantly increased. The first session is focused on the topic European trends in transactional risk insurance, providing an overview about the current market developments, new products, and much more insights into the M&A insurance topic. We welcome our speakers from Marsh and Latham Watkins, both companies well known and recognized in its field of expertise. On the left side, you can see Philipp Giessen, Dr. Philipp Giessen. Philipp leads Marsh's German private equity and M&A practice. After more than 5 years practical experience as an M&A lawyer at Latham and Watkins, Philipp joined the private equity and M&A practice in 2017, where he advised clients on the placement of warranty and indemnity policies, as well as special risk policies for transactions across numerous sectors and jurisdictions. He has also worked as an ICC arbitrator. On the right side, you can see Dr. Sebastian Pauls. Sebastian is a partner in the corporate department of Latham & Watkins Munich's office. His practice focuses on private equity and mergers and acquisitions. Sebastian advises on buy-side and sell-side transactions, including German and international financial and strategic investors, on acquisitions and sales of mid-cap and large-cap companies, carve-outs, minority investments, co-investments and management participation programs. Given his extensive and complementary German and cross-border experience, he has a keen sense of trends in the M&A market. One last sentence from my side before I will hand over to Philipp. In case you have questions, please insert them into the Q&A box in this webcast. The questions will be collected and answered at the end of the webcast. So please, Philipp, the stage is yours.
Stefan, many thanks for the introduction and good afternoon to everyone. The topic for today in this first series of a full webinar series on insurance and M&A transactions is giving you an overview of the European trends we see in transactional risk insurance. So the first slide you should be seeing on your screen is giving you an overview of what we are talking about when we refer to transactional risk insurance. So first and foremost, we are talking about WI insurance for the cover of unknown and identified loss or risk, and it works. Most of you know it the same way warranties work given by a seller or warrantor, so covering the unknown risks. And on the right-hand side of the slide, you see the contingent risk part, which is a growing part, very fast growing, and this covers the identified risks, typically identified in the due diligence, be it on sell side or be it on buy side. And this is for us a very interesting topic because it's a bit unusual for insurance, where you actually insure a already identified risk, in contrast to the typical insurance concept, where insurance coverage is granted for something which is not identified at the time of signing the policy. But going back to WI insurance, to give you an idea of how this product is used today, we can basically take away that the scope and usage has become more and more broad over the last years. You see it in a typical M&A deal, but you also see it. You also see WI insurance in joint venture situations. We have done many of those where the joint venture partners granted warranties. We saw it in loan deals, non-performing loans, performing loans. Basically, another situation where a seller granted warranties. Also in the areas of venture capital financing, also mezzanine financing, where you also have warranties. These are all areas where WI insurance nowadays becomes relevant. Contingent risk, obvious, we have certain areas, most prominently tax, but also environmental or litigation, potential ongoing litigation. These are fields where this product is used more and more often. Question to Sebastian. Now that we talk about where the product is used, so where is it not used?
Where is it not used? Yeah, that's a very good question. I think I start first on the positive side, because I think this is a very exciting trend that contingent risk insurances are growing in the market. So more and more insurers are willing to take those risks. And this is really interesting because if you look from an investor point of view, in the past, certain risks were uninsurable, and now they see the possibility that certain risks can be insured. And by this means, they may not need to go back to a price reduction or ask for an escrow to get some protection against those risks, but they can rather seek protection or transfer the risk to the insurer. However, I think this is all over subject to certain limitations, because as you can imagine, certain risks, if they are known, they cannot be insured, because the insurer will not be willing to take those risks. This will be in particular be the case in certain environmental situations, because if it's so obvious that the damage is done and that the costs will, or that the costs will incur, then the insurer will not take it. So I think this will be something you really need to look into, and this is where I'm getting to. If you have contingent risk insurance, what we see on transactions, it is cost intense. Further, you have to, because you need to conduct a very broader or more intense due diligence to make sure that the risk will be insurable. And then you have to think about the process, the timeline. So, because in particular, if you have a certain environmental risk, this may take even months to complete the insurance. And so it will not be an insurance you can take out pre-closing. So this all said, I think it's still a very good tool to look at the trends, the willingness of the insurers in the next couple of months and years to take those insurance, because it will give you a very nice advantage in competitive processes, because then you can, as stated, you do not need to look out for price reduction, escrow, or even an indemnity.
Also adding to the point, to have an honest conversation about it, where it should not be used is if you as a buyer, and it's a typical insured party, cannot conduct a let's say solid due diligence. Yeah, and the reason could also be that even though you as a buyer are willing to do the due diligence review, you are not provided by sufficient information by the sell side or the target. Yeah? And sometimes you have these situations for whatever reason that they don't have the information or are not willing to provide it. If you have a situation like this where due diligence is sort of slim, we should discuss in detail, and we can, with our experience, we can, give you a good idea of if it's insurable or not. But then we should check upfront whether it's insurable, because otherwise you will end up with an insurance product which is not what you expected. Because this is still valid since the beginning of WI insurance. WI insurance does not replace due diligence. It always covers for the risks that are remaining after due diligence, but it does not replace due diligence. I think this is very important to understand. Still in the market, and this has not changed. For a few exceptions, if let's say a few small business, just a certain sales office in a certain country may be insurable without specific due diligence in this area, in this country. But this, as soon as we are talking about substantial part of the business, insurers will need to see due diligence on this piece of the business.
Before we go to this slide, I think this is a very important part, because looking at the trend all over, it is possible to get more and more insurance coverage, because it's a very competitive market out there. But this is at a price, because we see on more and more transactions, you get a better coverage, but you need to deliver more and more intense due diligence to get such coverage. This is this is not only true for the contingent risk one, but also on the let's say standard W&I insurance side for unknown risks, because the insurers want to cover as much as possible. This we're getting there at a later point in time, for example, narrowing down exclusions, but this is all at the cost that we on the buy side then need to deliver the right level of due diligence.
Yeah. So how's the market developing? And we just have this very, let's say, easy slide here. You just can see, the numbers of policies placed by Marsh JLT specialty. I mean, I'm talking about transactional risk in total, and WI is an important part of it. And you see the number of policies placed in 2018, it's 450. In 2019, it's an increase by 38%. It's 623 policies. So we saw a big jump in the business, in the number of insured deals, and this is particularly relevant for the Eastern and Central European area, where this product has grown tremendously. It still grows in, let's say, more mature markets like Western and Northern Europe, but Central Eastern Europe, this is where it's catching up very fast. The most of the policies are still WI policy. It's WI policy. This contingent risk is growing, but it's the only smaller part of that number. And you may ask, like, how's the market in 2020? I mean, we all know in the European context, the number of transactions have not increased compared to the prior year, but quite much the opposite. So there is the market, the WI market is still open. All insurers are open for business. They see deals. They see not that many deals as in let's say in 2019, but so far it's okay. The market is okay. It's not good. It's okay. We see a spike in certain areas, sectors, for example, tech or infrastructure or infrastructure-related businesses. These are deals or areas where we still see deals, and apparently, or as a result of that, many WI insurances are placed in this area. Sebastian, what's the percentage of insured deals nowadays? Do you have information on that?
Yeah, we made a market study, and so we surveyed about 240 transactions in the period between July 2017 and 2019. And what we have seen is that 3 years ago, there were maybe 13% of the transaction insured. Now it is up to 35% all over. But looking at the PE side, it's like 48% on the PE deal side, which are insured. And if you look at the regional differences, because I think looking out from the European side, we see that in the UK deals, we have about 33% insured, 67% not. In Germany, we have, it's almost half-half, 54% insured on the deals. On the French side, only 11% insured and 89% not insured. So I think it's a growing market. It's a fast-growing market, and looking at from a German perspective, pure German perspective, I think there's almost no secondary deal which is not insured.
So then we come to the question: who is purchasing WI insurance in the market? And this is not a surprise. It's still most of the times the buy side, the buyer, who's taking out WI insurance. and this has, when you see 2018 numbers compared to the 2019 numbers, that's it's still of an uptick on sell side policies, but still on a very, very low level. And also in 2019, 96.6% of the policies placed were placed on the buy side for the buyer, i.e., where the buyer was the insured party and can go directly to the insurer. And this is the standard. This is pretty much the standard situation. Where you may ask, where in which occasions is sell side insurance used? Typically, we talk about fund runoff situations, and we've seen it as well in bilateral M&A negotiations, where you have a buyer who has some negotiation leverage and who's not willing to take out WI insurance, most often because the buyer may not be used to this concept, may not have experience, and so the buyer then basically forces the seller, and then the seller tries to get basically the escrow insured. We've done this many times, but it's, from an insurability point of view, from an underwriting point of view, and also from a process point of view, we always recommend to go with buy side compared to sell side.
Mm-hmm.
Sebastian.
And I think what we have seen now in the past, the following trend that, as Philipp stated, then in the end the buyer is the insured party, but on the sell side, or from a sell side perspective, what we see more and more on a regular basis, that the sell side is preparing the W&I insurance policy. What do I mean by that? It's so-called stapling. So you have two options of stapling. This means putting the purchase agreement together with the policy out there to the bidders, and then as a full package, so that they have less work to do, and so you can facilitate the timeline of a process. And to do so, the stapled procedure is that you can either talk to a broker. We have done this many times as Philipp, to approach the insurance market to get an MBI report, which fits to the SPA which you provide to the bidders, or you can take even the next step to say, okay, this is the SPA, and this is then you as a seller decide which insurance company seems to be the best. You prepare the policy, you negotiate the policy, and then you flip it over to the buy side. So by this means, you can really accelerate the timeline. What we have seen then, then if the buyer is ready with the buy side due diligence, that you can get to a signing together with the executed policy in less time than in the usual process.
On the when you ask the question, who is buying WI insurance or transactional risk insurance, is it strategic or private equity? So the both groups are not far apart from each other, whereas still over the last years, private equity sponsors as purchasers of WI are still dominating the market. This is due to the fact that this WI product, was basically was basically started in the private equity sponsor space. In the last years, it grew more and more common amongst strategic investors. We see many strategic investors who are getting very experienced with WI, but at the same time, we also see strategic investors who have, not yet the same experience like private equity sponsors. This is particularly true for sell-side work, as Sebastian just outlined, where we, as a broker, start on sell-side and basically putting together a package there. We see this concept mostly being done in with private equity sellers compared to strategic sellers. Sebastian.
I think it's the same thing. I think we still are in the phase where everybody needs to get a little bit more familiar with this product. But in the end, I think this is a growing trend. It's obvious. And we expect that more and more corporates will also follow this trend and will base transactions or use W&I insurance solutions in connection with the transactions.
A question that arises quite often: what is the limit typically purchased? And this is usually expressed as a percentage of the enterprise value. And the insurance market usually links it to the enterprise value, whereas as a buyer, you may link it to the purchase price, but the insurer looks at the risk as a part of, first and foremost on the enterprise value. And so the limit is a percentage of the enterprise value. So the average limit we saw in 2019 and the European region was 16.7%. A bit of more details behind this, behind these numbers is that in large cap transactions, this percentage or this portion is a bit lower than the average amount shown here, and the opposite is true for small cap deals, where usually this percentage is higher than the average amount. What we also see in particular in real estate deals, in infrastructure deals, is that purchasers obtain title insurance for a way higher amount, and then usually up to the purchase price. Title insurance is a product. It's a standalone product, but it's also used in connection with WI insurance quite often, where you basically the buyer is basically insuring the fundamental aspects, something that would be normally covered by fundamental warranties, meaning ownership of the shares by the seller, the relevant permissions being granted to perform the transfer of the business, and no encumbrances existing, and things like this. These are insured by title insurance. The cost, how much does it cost? And what we see here, we see a relatively stable rate online when you compare 2018 and 2019, with actually a slight increase. The rate online, just to explain, rate online means that the premium as a percentage of the insurance limit purchased. Even though the base premium, and we hear that quite often in the market, the base premium are a bit decreasing. You see in the market many enhancements being purchased. Enhancement means typically that the insurer is granting synthetic coverage for certain aspects. When I say synthetic, I mean that the insurer is actually granting more cover than the seller is. I give you an example. Indirect losses. It's a very standard situation nowadays. The seller under the SPA is only granting warranties for and covering direct damages, and the insurance policy taken out by the buyer instead is also covering indirect damages, including lost profits. And buyers are very keen for this enhancement. Same is true for knowledge scraping. Knowledge scraping means that you have knowledge qualified warranties, which obviously the buyer does not like. And so the insurer is actually able to grant coverage for those warranties as if these warranties would not contain a knowledge qualifier, i.e. the purchaser actually gets these warranties covered on an objective basis by the insurance, even though those warranties are granted by the seller on a subjective basis.
Mm-hmm. And I think that this is a very important part to look at. If you as a client, you look at the insurance cost, what you always have to keep in mind on the other side is the coverage. And what we have seen is that these enhancements are getting more and more important nowadays, in particular in deal situations, because if you use those enhancements, so you accept the fact that you need to pay a higher premium, but you can get a higher protection, a higher coverage, and you have less negotiations with the counterparty. So to give you some more enhancement or synthetic ideas is, for example, you extend the time limitations for claims to be made on the SPA. Under the SPA, you could, for example, agree to a time limitation of 1 year. Under the insurance, it will be 2 or 3 years, or for tax, even up to 10 years, or environmental issues. I think this is like always to be kept in mind when looking at the cost. You want to make sure that on the other side you have sufficient coverage, and then you need to evaluate whether this the higher premium is worth it to get the coverage you are aiming for.
Let's talk about claims and a few general points on this up front. So when we see the market and we see what clients are thinking about and focusing on, it's it's mostly aspects coverage. Also, like Sebastian said, pricing is one aspect, but also they ask a question: how is this insured in terms of claims handling? And it's a very valid question, because this is basically determining the value of the insurance purchased. So what we can see is in this whole claim area is that the notifications under WI policies have increased. We found this out when we performed our Marsh JLT study, where we looked at the past 10 years to see how claims and claims notifications actually have developed. What you can see here on this slide is that this is the green line. You see the percentage or actually, sorry, it's the blue line. You see the percentage of policies that we have placed where claim notification was made. In 2016, this was less than 5%, and in 2018 it was already 11%. And this is what we see also in this year. We see more and more claim notifications being sent under policies. When I mean claim notification, it does not mean necessarily that there will be a loss. Many WI policies actually require the insured to make a claim notification in case of a potential loss. For example, that that the tax authority is looking at certain tax years and tax types which are covered by insurance. And in that case, many policies would already require the insured to notify the insurer about this fact, even though it's not yet clear if additional taxes have to be paid for the relevant tax year. And if there's no additional payment, then this claim has basically then just became irrelevant, i.e. because there's no loss. There's a brand new study issued by Liberty GTS, which was one of the big players in the European area. A study actually released today, and Liberty said that they expect in the next 2 years this rate of policies with a notification to exceed 19%. So the insurers are of the opinion that they compared to policies issued, that they will see more claims. What Liberty in their brand new study also found is that smaller deals trigger more notifications than larger deals. It's a bit in a bit disproportionate fashion, and this was, in my view, also very interesting. Here is a bit information and numbers around when the claim notifications are sent out, and this is looking at the years of the policy coming into place. You see that and we compared two basically time periods against each other: 2009 to 2012 on the one hand, and on the other hand 2013 to 2016. What you can see is when you look at this later time period, 2016 to 2013 to 2016, is that 85% of the claim notifications occurred actually in the first 2 years. So it's the vast majority is in the first 2 years of the policy, because this is when the company basically has went through the first audit cycle. The buyer had the chance to look into the company more in detail, and then you find out, and then the purchaser typically finds out whether there is actually room for a claim. We can also see that the bulk of claim notifications occurs in the first 6 months of the policy, so at a very early stage. This is now the reason is that now the target is basically under control of the buyer. The buyer has chance to also perform sometimes post-closing due diligence, looking into the information more in detail. And when there's a claim, they send out the claim notifications, which is just which absolutely makes sense in our view. Another slide here on the question, very relevant question. What's the rate of payout? And we see of the claims notified, and this is where we had to make the clarification, where actually a loss is there, and the loss is then presented to the insurer. 84% of those claims have been paid out. That means if there in fact is a loss on the side of the buyer, there's a very good chance that there will be a payment by the insurer. Here you see an overview of what types of warranties or indemnities have been triggered when there was a claim made. So the biggest areas are tax, and this is insurers have seen this over the many years, that tax, even though it's not covering the full indemnity, usually only the unknown risks, so only a portion of the tax indemnity, you see many tax claims. And the next in line is financial statements, which is a relatively broad warranty, where you see also 23% of the claim notifications from the whole group. This Liberty study I referred to earlier, it actually comes to a similar conclusion. Also, tax and accounts are the areas where they see most claims. Sebastian, your comments on this?
But I think this is an important slide, because if you look at it, and if you look at a transaction, you're facing a process, you want to make sure that what you're buying gets the right coverage. So even there's a seller's liability cap of €1, it is often important that you still look out that you get a financial statements rep or a compliance with law rep and a tax indemnity. So those areas then are basically covered. The question is here, or which is also important when you look at the target, that all the other areas which you deem very important for the business itself are covered. And then you need to make sure that neither under the SPA or the purchase agreement, nor under the policy, you have a kind of boxing principle. That means that the more specific guarantee is only applicable, because you want to make sure that those broad warranties or provisions are applicable throughout any kind of matter. So this is one of the things, no boxing. It's a very important part. And the second part is that if you look at the warranty spreadsheet, if you want to achieve the right coverage, that you make sure that the warranty spreadsheet really reflects the coverage you need, and that there are not specific items are excluded, or maybe stating that one warranty prevails against others. So I think this is an important slide if you look at the operations and the business and to achieve the right coverage.
Thanks. Yes, and we are already at our last slide, which is a bit more text heavy, but let's go through that. The market, the European insurers market. What we have seen is we have over the last years, also in 2020, we have seen new insurers joining the market. It's still a relatively MGA, managing agent heavy market, but also insurers are entering the market. We saw only a few insurers pulling out of the market. For example, a few years ago, Zurich, for example, dropped out of the German market. But this is the exception. We see more and more insurers coming into the market. For the insurers which are offering insurance in the European market, you see that their underwriting teams are expanding. We saw in Germany quite impressively where the underwriting teams for the big players almost doubled, including with specialists on, for example, tax. We have seen many tax insurers, tax underwriters entering the market, and we mirrored the same basically, where we have also on our team a tax advisor, a certified tax advisor for tax risks, because they are nowadays so relevant. We've seen among this broader field of insurers as a bit of a specialization into certain industry sectors, where certain insurers are more keen on financial industries, for example, or tech deals, IP heavy deals. We saw this as well. Within the area or within the group of stakeholders, i.e. clients, broker, law firm, M&A advisors, we saw more and more professionalization with this product. We, for example, just in my area for the German market, we have nine brokers which are taking care of this product, WI and transactional risk product, all day long. This has in the past years, these teams were smaller, and we also see this at the law firms, where you have professionals that are taking this transactional risk topic into their focus. And the same is true for M&A advisors, which focus more on the process aspects, but they are also getting more and more expertise of this product and know quite well how to run insured transactions from a process standpoint. The competition amongst insurers is, and Sebastian said this already, is focusing a bit on coverage. Premium is another aspect of competition, obviously, but we see that clients, when they see an insurer, and it's a question of what is more relevant, premium or coverage, most clients tend to opt for the better coverage due to the fact that the pricing is relatively low and has been on this level like discussed before. Sebastian, terms.
And I think, what does it mean now from an insurance point of view on the terms of the insurance? So starting with the first point, the retention amount is a very important part when looking at the policy, because this is the amount you as an insured party need to bear yourself. So the seller with the €1 liability cap will not give you any money. So you are stuck with the retention amount. But what you see over the last, let's say, 12, 18 months, that the retention amount was decreased from 1% of the enterprise value now down to 0.25%. And then it will be interesting where this goes to, whether it will be even lower in the future. And this we already see once on the real estate transaction side, where we see zero retention amount, and the same is true partly against an advanced premium, additional premium, that you can get a nil retention amount for fundamental warranties protection. I think this is something to look out for in the next couple of months, where this goes to, whether the retention amount will decrease even further. Do you see any trend in this regard, Philipp? Oh, sorry.
Yeah, we see this. The market is pushing for also nil retention in the non-real estate market. I mean, in the real estate market, it's common. We are not there yet, but there's a good chance that in coming years that we may see nil retention concepts, because there's a very high demand for this.
And the next one is, I think, is a very important part to look out for in the next couple of months, years as well. It's the exclusion, the catalog of exclusions. So each of the policies is divided into two important parts, like you have a warranty spreadsheet where you see yourself the coverage for the specific warranties. But on the other side in the policy, you see a catalog of exclusion, which is applicable to all, to the overall coverage. So and there we see a trend that certain areas are narrowed down more and more. This is true for environmental aspects, it's true for pensions, partly for tax matters. So when looking at the market, we expect that the coverage or the catalog of exclusion will narrow down more and more. And together with the insurers, the brokers, we will work on that.
Yeah, and this is also due to the fact that we saw most of the competition around, the coverage. Like I said, when the clients are mostly focusing on the coverage aspects due to the relatively low premium, and then this is all about the set of exclusions. When you see a deal, you have basically two groups of exclusions. You have basically the standard exclusions of the insurer, which are also subject to negotiations, but to be honest, a little bit less negotiations because they're the basis of their business. But those are discussed on a constant basis in the deals. And then you have the deal-specific exclusions, which are basically mandated by the insurers on a deal-specific context, i.e., for each specific deals differently. And there you can push insurers and discuss with insurers how they actually can grant coverage there. And this is where we see that competition amongst insurers really helps.
Mm. And this competition also leads to the next point, where we have this synthetic protection getting more and more common. So what does it mean by that? If you look at the purchase agreement, you have a liability regime, you have a warranty catalog, and you have a tax indemnity. And what we see more and more, that certain provisions of the SPA of the purchase agreement will be disregarded, but will purely regulated then under the policy. So this takes off the pressure, for example, in an auction process, when it comes to negotiations, because those provisions you will only negotiate with an insurance company, but not with a sell side. And this is one of the aspects where we expect that the liability regime itself of the SPA will be less and less relevant, but will be replaced by the policy regime. And the second one is on the warranty catalog, what we expect, and I think Philipp can state some more on this one, that in particular in distressed M&A transaction, we expect that there will be no catalog of warranties in the purchase agreement, but only in the policy itself. So it will be purely synthetic. And it will be interesting to see whether this trend which might be applicable to the distressed M&A transactions will then transfer also to the regular M&A transactions in the near future.
Yeah, this is a good point. Yeah, we saw this this concept of synthetic coverage, where no warranties are needed anymore to be granted by the seller. We saw this already for real estate deals and in the European region. We saw this also for infrastructure deals, asset-heavy transactions, we also see this and currently, with a currently already ongoing, but with a, let's say, expected uptick in the future in distressed M&A transactions, where you oftentimes have the problem that the insolvency administrator is not willing to grant any warranties. And then if you want to have insurance, it needs to be synthetic. So this is something where we definitely think if insurers get more and more used to this concept, there's a good chance that in the, let's say, normal bread and butter M&A area, we will see fully synthetic concepts, which is in particular charming if you are a buyer in a auction process, where you can go back to the seller and basically tell the seller that no warranties are needed anymore. And this may actually help your bid to make the race. I think what is just important to understand is that when we talk about synthetic coverage, this does not mean that no due diligence is required. So basically the same principle as WI insurance also applies there. That means that the areas which are covered by insurance need to be diligenced by the purchaser's due diligence. And basically also the synthetic concept sits on top of the due diligence, meaning that all the aspects not flagged when doing a market standard due diligence approach, those are the aspects that are insured.
And I think this is an important part, because if you look at the due diligence one, if you're in a normal scenario where the seller is willing to give certain warranties, in this case, usually you need to make sure, or you need to be sure, that the sell side is still willing to provide the information you need for your due diligence, and that the sell side is organized sufficiently so that they can provide the information and disclose the right information, so that you get the due diligence done that you need to for the sufficient coverage. This will be particularly true for the distressed M&A side, where sometimes time is of essence and you never know in what shape the company's organization is at that point in time.
And this means that not every distressed M&A transaction will be insurable. If let's say management is gone, the people that have the relevant information, so seller is not able to provide information anymore, then this deal may be very tricky to be insured. Yeah.
So the next one we touched on already earlier, contingent risk. It will be it's a trend. There will be more and more contingent risk insurances out there. Just to summarize it one more time, so everybody needs to keep in mind in this regard the timeline, the due diligence that needs to be done to get it done. And so this is important that at an early stage, the parties involved, broker, advisor, and insurers are getting together to make sure that this all fits into the overall process and timeline of the process.
Yeah, and to add on contingent risk as our last point for today, we see also on the contingent risks also being placed of the day-to-day business of the insured. So this means that there does not necessarily have to be a M&A context. If a company has in their ongoing business has tax issues, this is also relevant for contingent risk insurance, and maybe depending on the relevant risk and the risk appetite out there, may be insurable. So this means that no M&A context is needed, and we saw in the last years many contingent risk placements without a underlying M&A transactions, just risks coming from the day-to-day business of the companies. So this is it for today. We have a few questions. There was a question, how are the numbers in Germany? I assume this is relevant for the limit. The limit size in Germany, it's and the average limit size of roughly 17%. This is also in essence true for Germany. This is also what we see. There was another question on the average percentage of limit for large cap transactions, and as I said, it's a bit lower than those 17%. It's roughly in it, but it's talking from my experience now. We don't have any like I can present you with a study there, but it's roughly between 13 and 14%, roughly. Yeah. There was a question of payouts and the amount that when we saw 84% of the claims notified have been paid. And a very good point. These, this does not say about the amount of the payout if the full payment was granted. So, we don't have any numbers on this, but what I can tell you also from my own experience is that in many cases, there will not be mostly in complex situations where we talk about indirect losses, the payment, the final payment will be not what has been brought in the beginning, because oftentimes you have those indirect sort of indirect losses with a complicated structure underlying, and this is then on the insurer side. Then you have an expert and checking it again, and then it might be a sort of a sliding scale, and then the parties meet in the middle in terms of in a settlement situation. Yes, I think this is it for today.
I think,
no
Philipp, there's one more question for you.
Okay.
When looking at it, the last one.
The question was any developments with respect to deal size for which insurance is taken out, especially with respect to small cap deals. Yeah, that's a good point. With the growing specialization of the insurers, there are also insurers which looked more and more into small cap deals, which in the past were difficult to be insured due to minimum premia. And when you have a small limit and you have minimum premium of, let's say, 95,000, it's then just not, it doesn't make an economic sense to have these insured. But now we have insurers with smaller minimum premium, and then also small cap deals are relevant for insurance. And so basically we see more small cap deals being insured, but also we see with a growing market capacity also very large deals being insured. For example, in August, our European team placed a limit of 1.2 billion euro. So it's a very big transaction, a very big limit. This is also the market capacity is there. And this means, we look into all deals, may it be small deals, mid-sized deals, or large cap deals, is all relevant for our market and for us.
Philipp, wasn't it when it comes to the small size transaction that the minimum of liability coverage is about 6 million? Wasn't there this number, like roughly?
We see smaller limits. We see also limits of 1.5 million, 2 million. Okay. Something like this. And with these new insurers specializing on small deals, it already makes sense to have these transactions insured. And the nice thing is, the insurers that have specialized on those small cap deals, they sort of tailor, or they adapted their approach a bit, knowing that for a small cap deal you cannot have the same underwriting process as for a larger transaction. So it's more easy for small cap deals as well. All right, so many thanks for attending.
Thank you very much.
And we hope that we could answer all questions you had, and have a good day.
I think, Stefan, turning over to you.
Maybe you can go to the next slide. Philipp, Sebastian, many thanks for this comprehensive introduction and overview into the European trends in transactional risk insurance. I think it was a really good start into this topic, in which we step really in almost each and every topic a little deeper. Here you can see the webinar calendar. I hope you get a little appetite to join all the others, whether it's the impact of the corona pandemic or whether it's tax insurance and all these other topics. We look forward to have you there. If you're more interested in other relevant topics in M&A, join us in LinkedIn, follow M&A Review. Thank you very much for joining.
Thank you. Bye.
Thank you very much.